Most important company in the entire artificial intelligence supply chain just posted a record quarter. It raised its guidance for the whole year, and the stock fell 4%. On a day the market hit a new all-time high. When the best possible news gets sold, pay attention. Something just changed, and almost nobody said what it was. Okay, let me set this up because it matters. Taiwan Semiconductor, TSMC, is the company that physically makes the chips, not designs them, makes them. Nvidia designs, Apple designs, everybody designs, and then they all line up at the same factory. So when TSMC reports earnings, it's the cleanest read we have on whether the artificial intelligence boom is actually real or just a story. And this quarter, the read was about as strong as it gets. Revenue, a record. Profit, up 77% from a year ago. And the part that should have sent the stock flying, they raised the outlook for the entire year, now expecting growth above 40%. That is a company telling you, out loud, that demand is not slowing down, it's speeding up. The textbook says the stock pops. Instead, it dropped 4%, and it dragged the whole chip sector down with it. Micron fell 8%. So what did the market see that the headline missed? Here's the twist. It wasn't demand. They just told you demand is accelerating. It was two completely different things. For TSMC, it was cost. And for Micron, it was China. Two separate fears, hiding inside one green earnings report. Let's take them one at a time. First, TSMC and cost. Buried in that report was one more number. They're raising how much they spend on factories and equipment this year by about 15%. Think about what that means. To keep up with all that lovely demand, they have to pour billions more into new plants, and the newest ones, the 2-nanometer factories, are brutally expensive to build. Their free cash flow, the actual cash left over, fell about 17.5% from the prior quarter, so the market did quick math. Revenue's growing fast, sure, but it now costs a lot more to produce each new dollar of it. And it asked the question every mature bull market eventually asks. This growth is real, but what does it actually earn? Now Micron, and this one's more dangerous. Micron did not fall because of TSMC, it fell because of a company most people have never heard of. Its name is CXMT. It's Chinese, and it just walked onto the field. CXMT has quietly become the fourth largest maker of memory chips on the planet, and it is expanding fast, and here's the detail that actually moved the stock. Apple is reportedly testing CXMT's chips. Now, why does that terrify a Micron shareholder? Because memory is a commodity. It's not a magic Nvidia chip nobody else can build. It's more like sugar or gasoline. One chip is basically interchangeable with another. And the one thing that destroys a commodity business is a new competitor willing to make it cheaper. That's exactly what a low-cost Chinese entrant is. The moat everyone assumed Micron had just sprung a leak. I'll put the two together because together they tell the real story. The demand question, the one this whole trade has been built on, is settled. TSMC just answered it. Yes, the demand is real and it's growing. But two new questions just took its place. One, how much does it cost to serve that demand? And two, who's going to be allowed to keep the profits once China shows up to compete? Neither of those is a demand problem. Both of them are harder. Now let me argue against myself because if I don't, I'm just selling you a scary story. There are real ways this read is wrong. 1. A 4% dip on a record quarter is not a crash. If demand keeps accelerating like TSMC says, that stock could be a gift, and this whole worry looks silly in 6 months. 2. Micron is genuinely cheap. It trades around 7 times forward earnings, sitting on roughly $100 billion of multi-year contracts. If those hold, the CXMT fear is overblown and the stock's a steal. 3. Building world-class memory at scale is really, really hard. CXMT being ranked 4th is not the same as CXMT being good enough for Apple's actual phones, so this isn't a crash call. I'm not telling you to sell chips. Here's what I am telling you. The easy part of this trade is over. For 2 years, you could buy any chip company on any dip because the only question was demand, and demand kept saying yes. That era just ended. From here, the market is going to start separating the winners from the exposed. The companies with a real moat, the ones with the technology lead and the scale, the TSMCs and the Nvidias, they can absorb higher costs and outrun a new rival. Commodity players, the memory makers staring down a cheaper Chinese competitor, cannot. So here's the test, and I'm putting it on the record. Over the next month, I think the chip sector splits. The scale leaders hold or recover. Memory keeps underperforming the group. If instead they all fall together, that's a real demand crack and I'm wrong. And if memory rips straight back to its June highs, then the China fear was noise and I'm also wrong. I'll tell you which on this channel. Most dangerous moment in any boom isn't when demand disappears. It's when demand is still booming and the market quietly stops caring because it's moved on to a harder question. Not is it real, but who gets to keep the money? That question just arrived for the biggest trade on Earth. So the next time a perfect earnings report gets sold, don't assume the market's being crazy. Ask what question it's really asking. Earl's full daily brief is on the channel. I'm Frankie. The asymmetric signal, one contra Ryan read a day. Subscribe.